Oh, that was
Depends.
funny.
So what are we talking
All
about
right,
today?
okay. All right, so I'm Lisa Handley with Remax Advantage Plus and the Handley Advantage team.
I'm Chris Handley with the Handley Advantage team.
Calvin Kaming, Cologne Depot.
All right, so we wanted to get on here and really actually talk about the reality of interest rates and the reality of some of the programs that are out there, because there's a lot of myths out there. There's a lot of misinformation out there, and so we wanted to bring Calvin in because Calvin's going to be straight. Whether you like it or not, he's going to tell it as it is.
Lisa said be really positive. We'll try to, we will be positive.
Yes, because there are positive and
Yes.
great things and
There
great
are,
programs
actually.
out there. So we want to talk about that. So thank you for doing this.
Yep. You want me to hit on, what would you like me to hit on first?
Well, let's talk about the actual interest rates.
Okay, so well, we're recording this on Friday. The labor numbers just came out. It'd be great to have this job, right? I don't know what job you can have where you can be wrong so much.
Mm-hmm.
So their prediction was, or their consensus was, it was going to be, they thought 160,000 new jobs came in at 256,000 new jobs. It's kind of like being a weatherman, right? It's like, oh, we think it might rain, it didn't rain, or it's not going to rain, and it rained, right?
So here's
they're
it's
way
good.
wrong.
The good part
Yeah,
is
good news.
Good news. A lot of jobs, new jobs.
People are still employed.
People
Yeah.
are still employed.
Here.
That's really the good news. But
The weak part of that is the jobs that were created were for people under age 24, and that was the majority of the jobs. So it was seasonal jobs, probably not ones that stay. So I think we'll probably see a correction. What typically happens is they put this number out there. It's like, oh my gosh, it's so great. And then next year in the fine print, revise, which they did this last year, revised by $81,000 jobs or 81,000 jobs. So it gets revised. But all that to say, that stuff all drives interest rates up, not down. And I was doing a recording yesterday, and you can make an argument that 30-year fixed rates can go to 6.5% or 8%. And it's kind of like, what argument do you want? Because right now rates are sitting right at that 7-ish range, right? Because of this jobs report, they're a little higher than 7. If somebody's being honest and there's no discount points, there's no nothing, you're a little bit over 7. Everybody will lie a little bit, just telling you how the industry is, because they want your business. Like, hey, we're 6.99, we're 6.5, and then you read the fine print, it's like, but it's a 1.78 buy down, or there's a cost to get that lower rate.
yeah, and that's where we're going to talk about the buy downs, because the buy downs are important and are a good benefit.
Yep.
So I think one of the most important things out of all of this is the fact that, interest rates are what interest rates are. And you and I and the loan officers, they have no control over this. But for the last couple of years, we can't even explain to you how many people have said, oh, I'm going to wait until the interest rates go down. And all of those people that sat on the sidelines waiting for the interest rates to go down, guess what the value of homes did? The value of homes went up. So now you have this meeting of higher home costs with the interest rates where they were at the time that they were going to wait it out.
Yeah.
So
And
it's all about purchasing power.
Yeah, we always talk about when's the best time to buy a house. The best time to buy a house was back in 2021 with the 3%. All right, but the second best time to buy a house is right now.
Yeah.
Because the homes are going to go up and the interest rates are going to fluctuate all the time. And they're not getting back down to 3%. Don't wait for that. It's not happening.
In December of 2023, all the predictions were coming out, where are we going to be? And they said, hey, by the end of 2024, we'll be back to about 5.5%. We're like, oh, thank goodness. Well, we're at a little over 7, right? So you can't do that. And now that house you were waiting for went up 5% last year, 5% this year. And now you're going, okay, now that home costs 10% more. So it's like, So if I would have paid the higher rate back then for that lower purchase price, my payment would have been lower than it is now. You know, so
yes.
it's not worth.
So let's
waiting.
talk about let's talk about the 4%, because you had somebody say to you
Yesterday,
hey, I heard interest rates are 4%, and they get very confused. So talk about that.
Well, the text was funny. He's a good client. He goes, hey, why are the rates in Minnesota so much higher? Because I see nationally rates are at 4%. I'm like, nationally, the Fed funds rate for Minnesota and every other state is at 4%.
Okay, say that again slower. Fed funds.
The Fed funds rate, the rate at which banks borrow money from the Federal Reserve is at 4%. So people will hear like, hey, the Fed lowered interest rates, and they'll go, sweet, we're at 4. Text Kelvin, and he's going to throw his phone against the wall, maybe make a hole, fix it, here and out. But
no, that's the door.
Yeah, I know the door. So you use the Fed funds rate is just the rate at which banks borrow money, and it does have some effect on rates, but typically when you see the Fed lower it, interest rates actually go up for a little bit and then they moderate off, and so
the Fed's funds rate is different than
that's what it's costing the banks
to get the money.
And they're not going to lend you money for nothing, so they have to tack on additional, and that's why we're in the 6.5%, 7.5%, because they have to get theirs as well.
They have to make their money as well. So that was one thing we definitely wanted to clear up. But now let's go to the good points. Can we talk about the good things? Well, I'm all about positivity.
Let's talk before we do that.
Oh, he's going to stay. This
is super positive. I'm going to give you, because I'm typically wrong. So I'm going to tell you what. So I have here the National Association of Realtors, Redfin, Mortgage Bankers Association, National Association of Home Builders, Fannie Mae, Freddie Mac, Bank Rate. Everybody gives a prediction at where rates are going to be this year. And everyone says we'll be around 6.5, 6 to 6.5. So no one is saying we're going to get into the 5s this year. No one is saying we're going to get into the 4s. No one is saying we're going to get into the 3s. So the rates aren't that far off of where people kind of think they will be for the year. So we can get closer, and there's some things we can do that we'll get into with permanent. There's permanent buy downs and there's temporary. Permanent meaning we're just buying that rate down and we're just going to take that rate.
For the life of the 30-year loan.
Yeah. The other ones are temporary, and we'll talk about temporary is my favorite because it gives us the least cost for the biggest bang, I think.
Right, and the thing you have to keep in mind with these interest rates is that even at 6%, truly even at 7%, it's still lower than it has been.
The 50-year average is around 8%.
Yeah. So that's the thing is, those of you that were in the market in the 3-4%, I mean, you got to keep in mind it was during COVID, it was during the wars, and that's one of the reasons why it was really low, because our economy was really, really rough. And now our economy is better, so the interest rates are going to go up. And so, but even though they're up, and you guys haven't seen or experienced it, we bought our first home at 8%. People that bought it back in the 1980s, they were sitting at 12, 15, and 17%. So 6 and 7 is still actually historically low.
And normally, most of the loans we're doing right now have a 6 in front of it, right? So, and that's, again, historically that's good. And then if you want to get into the weeds, which no one wants to on a video, but if you want to get into the weeds, there's a tax benefit for your interest deduction. So if you figure out what's my real cost, it's really lower. Yeah, but no one cares that much. So,
so you just have to keep that in mind when looking at it. Just don't sit back and wait for 5% because the homes are just going to continue to go up. So just keep that in mind. And those of you that bought, we just did one that they bought 3-4 years ago, and they had tremendous equity into that house that they could take and turn it into their new house. And so just keep in mind the equity in your house is going to kind of offset that interest rate. So keep that in mind. But let's talk about the options on how you can get it. Let's just start with the 7 because that's kind of where we're at right now. So we're sitting at 7%. I have a client who really wants to get into another house because maybe they need a 4 or 5 bedroom house instead of the 3-bedroom house right now. But they're talking about the interest rate. How can we help them get that interest rate to something that feels better?
So I guess what I would do is I would look at can we get any seller paid closing costs on that new purchase? If we can, it's nice to use those dollars to get that rate down. And now we can do 2 things. We can do a permanent buy down, right? That would cost, Chris and I were running numbers prior to starting the video, but it costs about 3.5% to 4% of the loan amount. So let's say your loan amount's $300,000, take 4, that's $12,000 it takes. And
up front.
So that's part of your closing costs.
Yeah, and then we were only saving a couple $100 or $100. What was the number?
A couple $100 a month on a payment. Yeah, and we figured it would take you almost 20 years to see that money back in what you would save in a month. And when you do a permanent buy down, you don't get that money back
It's just-
if you decide to refinance.
Right.
That's basically money you
It's
just
gone.
push towards
Yeah.
something
Yeah.
that you're not using anymore if you refinance.
Yeah, and so the temporary buy downs, there's three, right? There's everybody has one. They just get more expensive the longer you go. So we have you could do a 3%. It's called a 3-2-1 buy down, which means the rate starts at 7 and you go 3% under, right? So now you're at 4, then you go to 5, then you go to 6, and you go to 7.
Each year it goes up.
Right? It shifts. So I've never done that because the cost gets crazy, but I've done 2-1 buy downs where we are at 5 or we're at 7 and we go to 5 and then we're 6 and then we go back to 7 in year 3. The hope is that in that 36-month period, rates will get down. If you do the longer projections on rates, they say 2026 we probably should see high 5s, mid 5s, but they've been wrong.
But they've said that
They've been
before.
wrong.
They said that 2 years ago.
Yeah, and 2 years ago,
Yeah.
right? 2023, they said the exact same
Yeah.
thing. So let's not bank on it.
Yeah.
But if it's a way to get people in and then have a little bit like, let's ease into this payment a little bit more, and we know that we're going to have an increase each year. And when you do that, we're just looking at one. The first year it saved them $488 a month on their payment, and this is a $400,000 house, 5% down or 10% down. So not a crazy like, oh, that's an unrealistic one. It's $400,000 home, 10% down. So you're talking a $488 a month savings. That's a big deal.
That's a lot. That's a
The
lot.
next year it's a $250 payment savings, and then the last year you get back to your regular payment. So
But by that time, hopefully,
possibly refinance.
yeah, and so, but with that refinancing, let's talk
Mhm.
about the program
Yeah.
that you have. If they use you with Loan Depot and they need to refinance,
Yep.
what?
Real quick though, what's the cost on
Yep.
that
Yeah.
for,
Okay.
and then come
You
back? So
So the cost on that is 2.2%.
Okay.
So 2% of the loan amount gets that.
on like
done.
2% of $360,000.
Yep.
So
So
$7,200
Yeah,
bucks.
$7,200.
And so,
So-
just so you know, from a real estate standpoint, we try to get that in closing costs so that can be, so basically we
Mhm.
try not to get it coming out of your actual pocket.
Mhm.
We try to get that in closing costs to help cover that, even if we get maybe half of that in closing costs.
Yeah.
But that's part of our negotiations. That's part of why we negotiate, is to help you get that interest rate down. Try to do in the 2-to-1 buy down, whatever program it may be. That's part of that
Right.
closing costs.
So on that same program, so just so people get it in their minds, the first year your principal and interest is $2,040, then $2,278, and then the third year, kind of where you're at, it's the $2,528. So it goes from that $2,000 to $2,500, but you got a 2-year period there to get into that. So
Yeah.
it helps people kind of, and they go, okay, I'll probably get a raise in my job.
Yeah.
This will happen. Maybe our kids will be out of daycare.
Daycare,
Maybe we'll
that's a
be
big
out
one.
of diapers. Maybe,
Diapers, another big one. Yeah.
So, you've got some of those things to keep in mind.
It gives
too.
you a little time to work it out and
Mhm.
ease to it, but then they can come back and refinance with you.
So if you refinance, any money you spent that we haven't used up, let's say it's 2 years in and we still have, we're in the midst of that 2 years, you're basically front loading. I mean, this is going to sound, I'm trying to think of an easy way. You're kind of front loading your interest rate and you're basically putting that money aside. Well, if you refinance, any money we didn't use gets credited towards it. It's a principal reduction. And then when you work with our team, there's no lender fees, there's no appraisal fees. So that saves you again, another $1,800 plus appraisal, $2,400. So the only thing you're doing when you're refinancing it is paying mortgage registration tax, a little bit for closing costs, and then you got to set up that new escrow account, right?
Mm-hmm.
So your escrow account, think of that as a savings account for your taxes and homeowners insurance. So yeah, it's a good program. My favorite buy down though, is 1.5% the first year, and then a 0.5 point the second year.
Okay.
And I like that because because we're going to get into a market. I mean, you had it this past weekend.
Yeah.
Everybody. So just so everybody knows on the video, everybody in the industry says how bad it is, how slow it is, how this. But then you talk to you guys, and everything's busy, crazy.
I feel like spring has already hit.
Right. And I was telling someone like 27 flipping showings on a property, 6 offers, and we didn't get it, right? Because it was listed at $485. It goes for $515. And I'm just like, so part of my concern is when you're doing these buy downs, it's like, well, we're going to the seller to give us some money, but what if we can't get that much?
Right.
Well, we can do a 1.5%, and then 0.5% second year buy down, and that only costs 1.25%, so 1.25%. So it costs a lot less to do it, and it still has a pretty nice, the first year it saves you, let me grab it here. First year it saves you $351 a month on your payment.
Nice.
The next year $120, and then you're back to your normal.
So you're essentially,
Right.
when we're talking about points, so
Percent.
when we say points, it's basically you're prepaying interest on the loan.
Yeah, a
That's-
little, essentially.
Yeah,
right?
essentially it's like you're front loading some interest because they want to have that available to them.
Yeah, we're just
because they're
prepaying it.
offsetting
And
that.
that's why we're trying to take that money from the seller a little bit, and let's
Yeah.
take a portion of that and put it over here, and maybe you can't get 3% seller paid closing costs, but maybe we can get a point, then we can do our end, and then you guys will call me and say, hey, make this work, and then I'll do it.
Yeah.
You know?
So
From a seller standpoint, you guys, because we talk about
Yeah.
having the seller pay closing costs. From a seller standpoint too, just so you know, so number one, if you're needing to move out quickly and things like that, it's something that you can actually offer. Two, we can actually let people know that you're going to offer some of those closing costs.
Big deal.
So that is something that we can do. And also, when it comes from a seller standpoint, if we have a great house, tremendous house that we know that can sell, when somebody asks for closing costs, oftentimes we will just add that to the purchase price. So really, it's really not coming out of your pocket. It's actually just the buyer ended up financing that price. So just know that too, because there are little tricks, but that's all a part of our negotiation process, and we can talk more about that.
Something that we should have on our flyer, buy this home at 2% under market, right? So what does that mean? But at least it creates interest there.
Yeah.
And the seller, I haven't, in people's homes, the average days on market, yesterday when I was doing a video thing was 58 days. So 58 days on market, their sellers kind of going, and that's average, right?
Yeah.
So that means there's people above it
And people
as well. And so you say, hey, how about this idea all day?
Yeah,
Right?
and so when new builds talk about the interest rate that they offer, they offer those interest rates because they've already tacked that on to the cost of the new build. So that's why you see new builds are offering a lot of times 4.99 or 5.99, and all they've done is added that to the purchase price already. They've cooked that into the price.
Yeah.
So just understand that when it comes to new builds. Well, hey, I can get a really low interest rate with a new build. Well, that's because they've just put that into the price, and that's okay because it works for some people.
Right. Yep.
But just know that it's already cooked in there, and there's ways that we can negotiate with resale homes too to get you a lower interest rate. So that's why we wanted to share this today.
The other thing that we're doing with you guys right now until the end of February, so we have about 6-7 weeks, is we're doing a 1-0 buy down, which we haven't talked about. We're doing that for free. So whatever the rate is, so let's say the rate's 7, you start at 6 for the first year, saves you a little bit of money, costs you nothing.
Say that again and say it loud for the people in the back.
All right, so the people in the back, which there's no people in the back, so nobody knows. No, this is a big audience.
They're way over there.
They're at the framing store. But the people there, if they want to know, so we're doing just a promotion because we do a lot of business together that you start 1% under the market. So let's say we're locking at 7, right? For anybody working with Lisa and her team, they start at 6 that first year, and that's at no cost, and that's for any applications. You don't have to close by the end of February, but God, I would love it. If we close by the end of February, it'd be great, right?
Right.
But any application dated prior to, we're doing it for free. So, it's a kind of a no-brainer, and we've had a couple of those so far that, believe it or not everybody calls me first, right? So, shocking, and you should. If you're learning, you should. But if you didn't, it's kind of like, hey, you're 1%. I said because of the business that we do with the Handley Advantage team, it's 1% under market. So if somebody's up, it's just something different, and it's really
it's a
nice
bonus
traction.
to you.
Yeah.
It's a bonus to you.
Save some money.
Yeah, it's a bonus to you. And if I was going to buy some more rentals, I would use it. But nope, I'm not.
So
maybe flips.
I do have a question for you with that. If you're offering that one, if they wanted to, bump a little bit extra, you would just pay the difference. If you wanted, let's say you wanted a 2-1 buy down, you would pay the difference from what they're offering at the one. So you could effectively take a little bit of your own money, throw it towards it, but less than you would in a
that's a good
typical
idea.
scenario.
Yeah.
Good idea.
And for those of you that are sitting in with 50,000, 100,000, because there are those of you that are sitting with that much
Right?
equity,
I know.
take some of that equity, help lower your interest rate. Because yes, you're sitting in a house that has low interest rate, but now your house has increased so much that you can take some of that equity and put it back into getting another lower interest rate.
Yeah.
So keep that in mind when you're thinking about buying,
Yeah.
that you can use that money from your sale to help lower your interest rate even further. And that's completely up to you.
Yeah. One other thing I'm going to say, and this doesn't help them at all, but it does help me, and I've got a camera. So, I'm gonna talk about it. So one thing, we're doing some refinances right now. And I was I love doing, I'm a nerd on this stuff, and I love restructuring household cash flow. It's a big deal for me, right? But I'm looking, cash out refinance, rates at 7, so you're like, hey, your rate's 7.75, and they're like, oh my God, are you serious? I'm like, oh, here we go. Okay, so I'm like, in my mind, I'm getting ready. I'm like, okay, but here's national average, here's this thing. Go, I can't believe that rate is so good. I'm like, that's great. And I said, what? And they go, well, it's so much better. I'm paying 29% on $57,000 of credit card debt.
Yes.
And their cash flow, household cash flow, went down dramatically. I mean, so if you're in trouble a little bit, let's have that conversation, because there's things we can do there too.
Yes.
Which flips us into our next conversation, which needs to be around escrow accounts.
Yes. Let's talk
Okay.
about escrow.
So as you know, you get, when you're doing a mortgage, you have your principal and interest, and then you set up this escrow account. That escrow account's a savings account essentially for property taxes and homeowners insurance. But man, oh man, the amount of calls that we've received together saying, hey, why did my payment go up? I can't afford this. And then there's this other sneaky little thing, if you bought a townhome or condo, or you're in a single family home development and it has an association. So there's 3 factors that shift there. Association fees can change, property taxes have been going up, and homeowners insurance. Good Lord.
Yeah.
I mean, I got denied. They canceled. So my homeowners insurance coming up for renewal. Yeah, cancel. I'm like, I'm the best guy ever, right?
Well, our insurance company,
Left
Minnesota.
literally left the state of Minnesota.
Yes.
So if your payments are going up, that's a
It's
big
not
reason
the interest
why.
rate.
Yeah.
It's
And
not the interest rate.
One
I
thing
thought
that
this
you
was
you mentioned about, so tax rates in a lot of
Property
municipalities.
taxes you're talking
Yeah,
about.
so like property taxes, most of the increase that you're seeing in your property taxes isn't an increase in the property tax rate, it's an increase in the valuation of your home. So your property value has increased, which means you're being taxed on more. Even if it's the same amount, it's more money coming out of your pocket. There are places, I know Lakeville was one of them. So Lakeville, their taxes actually went down a little bit, the percentage rate,
Really?
Yeah.
but their values went up, so their amount they're paying in taxes. So this is a discussion that we would love to have with you in person.
And
to
call
talk
us
about.
if you have questions on this, because it is that price goes up and people often wonder why. But and here's the thing: is if you've done any improvements, if you've gone out and gotten permits to do improvements or add finished square footage to your basement, that's going to actually increase the value of your house, which then you're going to get taxed on. So that's why it's now popped up again. Also, for those of you that have bought new homes, there's such thing called as shock tax. And in your closing, you actually had to sign a piece of paper that said, be ready for your shock tax, which means with your new build, you're paying the taxes of basically the blank land, no house on it. Well, as you're living in there, that's going to increase to the actual value of your house. And I have helped clients, multiple clients, that were not prepared for the amount the taxes were, because they might have been misled a little bit on how much the taxes actually were, and all of a sudden the payment went way higher than what they were comfortable at. And so that's something that we need to talk about, is if we want to make sure that we have your mortgage payment right. And so we kind of, when people talk about right sizing houses, we actually talk about right sizing your mortgage. So maybe you need to move out to right size your mortgage.
And we've had a situation with that, and when it's a new construction, we use what's called a mill rate. So it's basically the tax on the land, and then over a period of time that goes up, and then about 18 months in, you're like fully assessed, and that's where that shock. I haven't heard that shock tax comes into play. And it's dramatic, and people aren't ready. And sometimes we anticipate X, and it does turn into Y, and because we don't know that either, we just anticipate what it's going to be.
Yep.
So it is, and I just give hats off to people that have the courage to kind of say, hey, this is a little bit above what our means are, and we don't want to live indebted to our mortgage. And I'm in the business, you guys are in the business, but good Lord, don't let your mortgage, don't let your home run your life.
Don't be house poor. We always say that. Find the house that you can be without being house poor, because you got things that you want to do.
Right.
So it's okay if you bought a new house and everything ended up being more and bigger and more expensive. It's okay. Call us. You are not alone. You are not the first.
Crazy.
You're not going to be the last. We can help you take care of that, because the other thing is now you have that. And then the insurance was such a big hit this year. Insurance,
Crazy.
we literally, Minnesota had the most claims, because everybody thinks Florida and hurricanes, but it's us with the hailstorms and the tornadoes that we've had and those kind of things. That's why our rates have gone up. So unfortunately, I mean, we're experiencing it ourselves. Just so you guys know that you're not alone. We're experiencing this in our investment properties. We're going to actually sell our investment properties, because between the insurance, and the taxes, and the HOA fees, which have gotten crazy. We're selling our investment properties because of this.
Because of cash flow, or what? Just because
the cash flow doesn't make sense.
And the fact that you pay for your tenants.
Yes.
If you're looking for a rental, these are the guys, because you don't even have to pay most of this.
Come and rent from us, and we'll pay your mortgage.
If you pay every other month, you'll even get invited to a party once a year. That's awful.
So, but
with that though, but
we're
I mean,
seeing this from a lot of investors too. They're like
insurance and taxes, and they're just like, I'm out. So it happens. So if you've been thinking about investing in rentals, that's definitely something we need to talk about, because it is real with the prices of houses right now. And everything that we just talked about, that's real. You have to figure those things in, and you do have to figure that some people may not pay you for 1 or 2 months. It's just 80% of renters are fantastic, 20% are not. So we can definitely talk about that.
I might dispute those numbers.
Yes. And the 20% usually apply with me or with the Handleys. So, that's how it is. You know what I like? I like duplexes, triplexes, where you live in one of them. So now I can finance that as a primary residence with 3% down, 3.5% down, 5% down, and yet I have 2 units.
And you can homestead it too, so you get a tax benefit.
And with that,
so that's a good idea.
Yes, a new 5-plex just came on. So if you're looking, there's a new 5-plex that just came on.
Seriously?
So just call me about that. So because those are the ones that I like, those too, because then you have, if one or two aren't so great, you're there. And it's a little easier to do it, but when it's a house or a single, like a condo that we have, it can be a little tricky.
For sure.
So, anything else you wanted to cover?
No, I just think in all of this, right, there's a lot of information in all of it. Where it starts is just with a conversation, and I just would say the conversation that we'll have with you is going to be different than any other conversation, because we're going to hit on stuff that's just not mortgage. We're going to look at your household cash flow analysis and make sure we're making smart decisions. And smart people call us. So if you're smart, you probably call.
And even with the investments that we were just talking about, I don't want to scare you away from investing if you're that, because even with those 2 investments, after we now sell it, because we bought it and have fixed it up, it's actually just been a longer term flip, because we're going to make money on those too. So don't think of it as a completely scary bad thing. Just know that, we held on to it long enough that we're actually going to make money on the back end of it anyway. And so there's different things to talk about. And then again, if you want to know what the value of your house is, because maybe you want to know how much equity you're actually sitting on, because trust me, that's my favorite part of the job is when we can go through and tell people what their equity is, and that's a good shock value, because they're just like, no way, because we just bought it for this price and we're selling it for this price. And it's very fun to see people, find out that their house may be worth more than they think it is.
Even if they just bought like a year ago, year and a half ago?
Even 2-3 years, it's not quite as much increase as we saw a couple of years ago, like year over year. But like you had mentioned, 5-10% over a couple of years. I mean, that outperforms almost any stock index.
Yep, and I'm going to give you an example. Maybe you bought a home that you're not real happy with, or your family has grown, or something has happened that you needed to maybe upsize, downsize. But we literally just closed on one not too long ago that the owner bought a townhouse, but now they wanted to get into a house, and they lived in there very short time, and we were able to find that person a house, close on their townhouse. We were able to get it.
She lived there 9 months.
Yeah, 9 months, and I think it was a little bit more than that. But any which way, we were able to take and sell the townhouse for more than what she bought it for, and get into the house that they wanted without having to have any cash out of her pocket. It literally came from the sale of her house. So if you're thinking about doing something like that, call us, because you might not even have to come up with cash out of your own pocket. It might just come out of the sale. So little things like that, reach out to us. That's what makes us the professionals. We know what we're doing. We know how to get your house sold. We know how to make it look the best for pictures and to get people's eyes on it and to get in there and get it sold. So give us a call, 612-390-6520. If you need to talk to Calvin about lending options, whether it be helping get the interest rates down, or we didn't talk about it here, we'll talk about it in another one, some first-time home buyer programs, some first-generation programs, which are fantastic. Which are getting renewed from what I understand. As I heard
most of them renewed. Like the last ones we've done are run around 53,000 that we're getting. We have one right now where we're stacking first gen and then Minnesota Housing on top of it. We have another one where we just put a third on. That one's about 72,000. Wow. There's one if you're just real quick, if you're moving to Illinois, call me. I've got one going there right now for one of our guys. They have a program. They pay $40,000 off your student loans when you buy a new home, and they give you $5,000 for closing costs, 0% interest, paid back over 10 years. So there's money everywhere you're going. And it's crazy, right?
We did find out about another one that's here, but it has a little stipulations, and it has to do with having to go to a church every Sunday and having a
put a crucifix in your house,
because they will do pop-bys, but they're giving free grants for money for homeowners.
It was a lot of money.
So
it was over $50,000.
Yes, there are things like that, you guys, that you have no idea are out there that we do. Reach out to us. We're here to help you.
I'm not doing that.
We are here to help you with whatever you want to go, or whichever, whether you're upsizing, downsizing, moving out of state. If you're moving out of state, we have fantastic agents we can connect you with. If you go to
we're in
Illinois,
every state.
But if you go to Illinois, I got a great one there, just so you know. So just let us know. But reach out to us again. Lisa Handley, Chris Handley. Want to give me your phone number?
Yeah, Kelvin Kaming, Cologne Depot, 651-231-2500.
Reach out to us. Let us know if you have any questions. We are seriously here to help.
Sounds great. Thank you.
Have a good day.